Welcome to Solidarity Spotlight, the place where we share with you bleeding-edge stories. I'm your host, Solidarity. Let's discover what's happening today in blockchain. The cryptocurrency and blockchain ecosystem is experiencing a particularly turbulent and transformative period as we approach the end of November 2025. Today's developments paint a complex picture of market volatility, regulatory evolution, institutional participation, and technological innovation that collectively signal both challenges and opportunities for the digital asset space. The most immediately visible story dominating market sentiment involves Bitcoin's sharp decline, which has become the central focus of investor attention and anxiety. The flagship cryptocurrency has dropped below the $94,000 mark for the first time since early May, representing a significant pullback from its October all-time high of approximately $126,000. This decline has triggered what technical analysts refer to as a death cross, a pattern where the 50-day moving average crosses below the 200-day moving average. This formation historically signals bearish momentum and has sparked considerable debate within the trading community about whether this represents a local bottom or the beginning of a more sustained downturn. The Fear and Greed Index has plummeted to extraordinarily low readings, with some measures indicating extreme fear at levels not seen since April. Market analysts attribute this decline to a confluence of factors, including shifting Federal Reserve rate cut expectations, reduced liquidity in the market, and substantial selling pressure from long-term holders who accumulated Bitcoin over many years and are now taking profits after the extraordinary gains realized throughout the year. The liquidation dynamics unfolding across the market reveal deeper structural concerns. Short-term holders are now collectively holding approximately 2.8 million Bitcoin at a loss, marking the largest underwater position recorded since the FTX collapse in late 2022. This metric is particularly significant because it indicates that nearly all coins acquired since mid-June, when Bitcoin was trading around $104,000, are now positioned below current price levels. Meanwhile, long-term holders have continued distributing their holdings, with data showing that long-term holder supply has fallen by over 450,000 Bitcoin since July. The implications of these movements extend beyond simple price action, suggesting a fundamental shift in market structure and participant behavior. Exchange-traded fund flows have become a critical indicator of institutional sentiment, and the data is decidedly bearish. Bitcoin spot ETFs experienced their second-largest single-day redemption of $900 billion in net outflows, with cumulative outflows over a 3-week period reaching approximately $2.6 billion. This represents a significant reversal from the consistent inflows that characterized much of the year, following the approval of spot Bitcoin ETFs in January. The outflows have been particularly pronounced from major issuers, with significant withdrawals from the largest Bitcoin ETFs. Interestingly, even as Bitcoin ETFs have experienced outflows, the assets under management, measured in Bitcoin terms, have remained relatively stable, dropping only slightly from 1.38 million Bitcoin to 1.33 million Bitcoin. This divergence suggests that recent price declines, rather than fundamental loss of confidence, are driving some of the outflow dynamics, as institutional holders are capturing profits and rotating capital toward other opportunities. Amid the bearish market environment, Harvard University's recent decisions regarding Bitcoin exposure present an intriguing counter-narrative. The university's endowment, one of the world's largest, with approximately $50 billion in assets, has tripled its stake in BlackRock's Bitcoin ETF during the third quarter of 2025. Increasing its position from approximately $117 million to over $440 million. This represents a remarkable 257% increase that positions Harvard among the largest holders of the institutional Bitcoin investment product. Perhaps even more striking, Harvard has also doubled its position in gold exchange-traded funds, suggesting a coordinated defensive and long-term positioning strategy. This move from one of the world's most prestigious and traditionally conservative institutional investors carries significant symbolic weight and raises questions about what signal Harvard's portfolio managers are attempting to send regarding future economic conditions and the role of both Bitcoin and precious metals as hedges against systemic risks. The broader cryptocurrency market has witnessed substantial volatility among altcoins, with particularly dramatic price movements in privacy-focused digital assets. Zcash has experienced an extraordinary price surge of over 1,500% in 2025, climbing above $700 and capturing significant attention from both retail and institutional investors. This remarkable rally has sparked considerable debate within the cryptocurrency community, with Bitcoin advocates criticizing the move as a pump-and-dump scheme, while privacy coin supporters emphasize Zcash's technological innovations, including its zero-knowledge proof architecture and the growing adoption of shielded pools. The privacy coin's resurgence reflects broader institutional interest in privacy-preserving transactions, particularly following regulatory developments that have provided greater clarity around how privacy coins can operate within compliant frameworks. Major investors and institutions have allocated substantial capital to Zcash, including significant positions from well-known cryptocurrency figures, suggesting that despite its controversial nature, privacy-focused digital assets are increasingly recognized as having legitimate use cases within institutional portfolios. The landscape of decentralized finance and institutional participation continues evolving in meaningful ways. The development and deployment of new protocols designed to improve capital efficiency represents a significant technological advancement. A major decentralized exchange aggregator has unveiled a new liquidity protocol that enables applications to share a single capital base across multiple strategies without requiring users to lock their funds into individual smart contracts. This innovation addresses a fundamental inefficiency in current decentralized finance, where capital tends to be fragmented across numerous protocols. The ability to deploy the same assets across multiple strategies simultaneously while maintaining custody represents a potentially transformative development for liquidity providers seeking to maximize returns on their capital. Market impact from such innovations typically materializes gradually as developers integrate the technology into their applications and as users gain familiarity with the new capabilities. Regulatory clarity regarding cryptocurrency trading infrastructure has advanced significantly, with the Singapore Exchange announcing plans to launch Bitcoin and Ethereum perpetual futures contracts. The contracts, set to begin trading on November 24th, provide continuous exposure without expiry dates and will operate within a regulated, exchange-cleared framework. This represents a major step in bringing cryptocurrency derivatives onto established market infrastructure, addressing long-standing concerns from institutional participants regarding counterparty risk and operational standards. Perpetual futures globally account for over $187 billion in daily average trading volumes, with much of this activity currently occurring on offshore platforms outside traditional regulatory environments. By offering these products through an established, regulated exchange, Singapore is positioning itself as a major hub for institutional cryptocurrency derivatives trading and signaling a broader trend toward integrating digital assets into mainstream financial infrastructure. The expansion of cryptocurrency investment products through exchange-traded funds has accelerated dramatically, with multiple XRP exchange-traded funds launching in rapid succession. Canary Capital launched the first spot XRP ETF with an impressive $58 million in trading volume on its debut day, establishing a remarkable record for an ETF launch in 2025. Multiple major asset managers have announced subsequent XRP ETF launches scheduled for the coming days, with Franklin Templeton preparing to launch its own XRP product on November 18th. This represents perhaps the fastest proliferation of ETFs for a single cryptocurrency outside of Bitcoin and Ethereum. The staggered launch schedule, rather than the simultaneous debuts that characterized Bitcoin ETF approvals, creates ongoing media attention and potentially multiple opportunities for institutional capital flows into the digital asset. Analysts expect these waves of launches to generate sustained demand and liquidity improvements for XRP trading, potentially supporting price appreciation if new capital flows exceed redemptions from existing holdings. The regulatory and legal landscape surrounding cryptocurrency continues to generate significant headlines and establish important precedents. A highly publicized trial involving the developer of a popular cryptocurrency mixing service concluded with a conviction on one conspiracy charge, but a mistrial on more serious allegations. The case raised fundamental questions about developer liability for third-party misuse of open-source software and protocols. The jury's inability to reach consensus on the most serious charges while convicting on the unlicensed money transmission charge suggests nuanced views within society about the boundaries of developer responsibility. This legal outcome will likely influence how cryptocurrency developers approach compliance and risk management going forward, with particular attention to identifying and implementing safeguards against illicit use while preserving the permissionless nature of blockchain protocols. Investigative journalism has unveiled the extensive involvement of major cryptocurrency exchanges in processing illicit funds, with coordinated reporting from numerous journalists across multiple countries, identifying tens of thousands of transactions linked to criminal enterprises, including drug trafficking operations, money laundering schemes, and state-sponsored hacking groups. The investigation highlighted how cryptocurrency's speed, global reach, and pseudonymous nature have created what amounts to a shadow financial system operating parallel to traditional banking infrastructure, but with significantly less regulatory oversight. This reporting is likely to accelerate regulatory scrutiny and compliance requirements for cryptocurrency exchanges, particularly regarding know your customer procedures and transaction monitoring. The intersection of geopolitical tensions and cryptocurrency adoption has become increasingly apparent, with military escalations in specific regions reportedly driving increased demand for decentralized digital assets among populations living under less stable governance structures. The combination of military posturing in certain regions and selective tariff policies is being interpreted by some market participants as creating an environment where cryptocurrency's properties as uncensorable, boundaryless assets become increasingly valuable. Simultaneously, traditional financial institutions continue expanding their engagement with cryptocurrency infrastructure, with major companies implementing custody solutions and trading capabilities for digital assets. Technology companies within the blockchain space continue rolling out significant infrastructure upgrades and new services. One major Oracle and smart contract infrastructure provider launched a runtime environment specifically designed to enable institutional-grade smart contracts that operate across multiple blockchains while maintaining compliance and privacy requirements. This platform is gaining adoption among major financial institutions and enterprises seeking to deploy tokenized versions of real-world assets, including securities, real estate, and other instruments. The technology's ability to abstract away blockchain complexity while maintaining security and regulatory compliance represents an important step toward broader institutional adoption of on-chain finance. Another major blockchain network has implemented significant validator performance upgrades, with preliminary data suggesting meaningful improvements in transaction processing efficiency and reward generation. These technical improvements, while less visible to retail users, establish important competitive advantages in blockchain infrastructure and can meaningfully impact the network's ability to support enterprise and institutional use cases. Financial results from various blockchain-focused companies reveal a sector increasingly focused on profitability and sustainable revenue generation, rather than speculative positioning. Multiple companies reported positive earnings in recent quarters, with revenue growth accompanied by expanding margins. These results suggest that blockchain-native businesses are maturing and establishing genuine economic models that generate returns independent of asset price appreciation. That concludes today's Blockchain Spotlight. I would love to know your thoughts. Thanks for listening, and don't forget to follow me for more spotlights. See you next time.